So, hi everybody, this is Also Hub. I'm Giacomo, and today I'm going to analyze Morningstar. This is one of the stocks that you asked me to analyze. It's a really interesting company. I really like it personally. So, I've never used the databases of Morningstar, but I've used the website and so on, and it's very famous among the financial world. So, yeah, seems to be a very interesting company. Um, Before we get into the video and we discover if there's some value into Morningstar, a few disclosures. First of all, this is not financial advice, so do your own research. And second, the data that I've used comes from Seeking Alpha and a New York University website for the risk premium and so on. So here's the uh, first assumptions that we make. We estimate the weighted average cost of capital. We start off with the cost of equity and then the cost of debt. Here's how I calculated it. So I've taken the interest rate swap for 10 years on the US dollar that is around 4% as of now. So I've taken that as a base. Then I've taken the risk premium, that is the risk premium that I found on Aswat Demirel's spreadsheets. So I've used that. And then here's the beta for the last 24 months for Morningstar. And yeah, it was 1.2. So here's the cost of equity that comes as a result of that. So here you have the formula if you want to see it, how I did it. Yeah. So next, the cost of debt, also interest rate swap plus a spread. So here's the spread that I've used for Morningstar, and here's the debt to capital ratio. It's not too low, but not even that high, and I think that Morningstar can afford it because it's a very safe company, very well positioned. It has a moat. It operates in a field where not many companies operate, and yeah, so I think it is well positioned. So here's the estimations that I've made for the weighted average cost of capital for Morningstar. So here's some highlights for the last 10 years. We can see that it has grown quite amazingly. Revenue, earnings, free cash flow. So yeah, it has done pretty good in the last 10 years. So yeah. Next, we start by making some really important assumptions, and we make an assumption on how the free cash flow could grow from now on. So here's how I've made these assumptions. So we can see that around the past years, Morningstar has grown a lot, and then it kind of stopped and went down around 22, 23, basically when interest rates were starting to go higher and higher. And so, given that the consensus is around, so the Fed is expected to cut rates, the ECB is expected to continue to cut rates. I think that Morningstar could be a really good beneficiary. More companies issuing debt. Probably, given that one of its most important products is PitchBook, that is widely used by the venture capital world. The venture capital had some quite rough years given the steady increase of interest rates. So having a harder time raising capital, investing in startups, and so on. But if the interest rates were to go down, all that world, private equity, venture capital, and so on, could get a big boost again. So Morningstar could benefit from that side as well, on top of course, reducing its cost of capital. So that's why I've made some very bullish assumptions. I think that without the last 2.5 years of a little bit worse environment, Morningstar would have done a lot better than that. And yeah, the world is it's more dangerous right now, but I think that given that Morningstar is exposed mainly to the US, the US is widely expected to do well economically speaking. So yeah, I think that Morningstar can do well, especially in a lower interest rate environment. So I've made some assumptions, um, expecting the company to do extremely well in the short term, given that is expected for the interest rate to go down, for the Fed to cut rates. And second of all, what I like specifically about these companies that have a service that is subscription based, like the databases of Morningstar, PitchBook, and so on, is that once companies base their workflow around a specific software, they train their employees around a specific software, they can't change it overnight. Yes, for example, I think that a few years ago, JP Morgan made a few cuts on Bloomberg licenses for people that were not really in need of Bloomberg, because Bloomberg is known for not negotiating at all the cost of its licenses. But you can't really cut that much, because even in bad times, unless the company goes bankrupt completely, you can't really cut on the software that you use to run the company in itself on the daily basis. So in bad times, I prefer to have these stocks that are less volatile, that are really, really important for businesses to be run. So financial firms need these databases to run their business. So even in bad times, they can't really cut that much. They probably cut more on marketing and stuff, but you can't really cut on the databases that you use to keep track of your investments, research various investments, and so on. So I think Morningstar is in a very good position. Very few competitors. You have Bloomberg, you have S&P, Moody's, FactSet, and so on. But it's kind of, you don't have that many competitors if you compare it to, I don't know, consumer goods, car companies. Car companies, maybe there are not that many competitors, but it's a very volatile sector, because the first thing that people do when bad times arrive, they cut on expenses that are not really necessary, and a new car is certainly the first big expense that they can cut on. These softwares, they are very much needed by the companies that use them, so I don't think they can really cut on these expenses, such as the databases that Morningstar provides. Morningstar would also benefit from the issuing of new debt and new subscriptions, of course. But yeah, that's why I foresee the company to do very well in a lower interest rate environment. So here's the explanation of the assumptions. So higher than what it has done on average in the last 10 years, because in 22-23 we have seen a very steep increase in interest rates, and now they are widely expected to go down. So here's the calculation for the terminal value, and here's the present value of that terminal value. I've added the terminal value to the value of the free cash flows, and then I've subtracted the debt and the employee benefits, such as restricted stock units. So yeah, here we come with the value of equity and divided by the outstanding shares. I've seen that Morningstar has slightly increased the outstanding shares lately, slightly, but in good times it has also bought back stocks. So in case of bad times, we could see Morningstar buying back a little bit more, and that could further increase the value of your shares. So the final figure is this one, around 370. The share price is trading at around 320. So yeah, it's about a 15% increase. It's good, but it's not. This doesn't make the company really cheap. It is a good bet. It is in a well positioned area. It has a pretty good moat, not the strongest one, but a pretty good one. I think it could do very well in a lower interest rate environment. It's not really a value bet as of now, but it's a very good company, and I would never bet against a company such as like Morningstar. So if it were to go down in the short run for some minor things, I would probably make it a buy. I think it might as well be a fair buying opportunity. As of now, not as cheap as I would have liked it, but yeah, this is my point on Morningstar. So this is it for today. Make sure to like, subscribe, and comment for more videos like this, and let me know in the comments which stocks you want me to analyze. So this is it for today. I'm Giacomo. This is Hustle Hub. See you next time.